Welcome to Unit 3.4 Final Accounts Part 2. In this section, we will delve into the intricacies of final accounts, focusing on balance sheets and their components. Our learning outcome for this unit is to analyze, apply, and prepare final accounts, specifically focusing on the balance sheet. The balance sheet is a snapshot of a company's financial position and net wealth on a specific date. A balance sheet is divided into three main parts: assets, liabilities, and capital and reserves. Each section provides crucial information about the company's financial health. Assets are resources owned by or owed to a company that have monetary value. They are categorized into fixed assets and current assets, each serving different purposes in the business. Fixed assets are long-term resources purchased for business use, not for resale, and are expected to last more than 12 months. Examples include land, buildings, machinery, and vehicles. Current assets are short-term resources likely to be converted into cash within 12 months. These include cash, debtors, accounts receivable, stocks, and inventories. Liabilities represent the legal obligations of a business to repay money, such as loans and supplier credits. They are divided into current liabilities, due within 12 months, and long-term liabilities, due after 12 months. Capital and reserves, also known as shareholders' funds or owner's equity, include share capital and retained earnings. Share capital is the money raised from selling shares, while retained earnings are accumulated profits. In exams, balance sheets follow a specific format, detailing assets, liabilities, and equity. Understanding this format is crucial for accurately preparing and analyzing financial statements. Balancing a balance sheet involves ensuring that net assets equal long-term liabilities plus owner's equity. Alternatively, owner's equity can be calculated as net assets minus long-term liabilities. Let's construct a balance sheet based on financial data for Company A. This exercise will help you understand how to organize and present financial information effectively. Here is an example of a balance sheet for Company A as of December 31, 2024. It includes assets, liabilities, and equity, providing a clear picture of the company's financial position. Balance sheets have limitations, such as static information that may vary over time, differences between book value and market value, and the lack of standardized formats for comparison between businesses. Our next learning outcome is to analyze and apply different types of intangible assets. These assets are non-physical but add significant value to a company. Intangible assets differ from physical assets because they generate income, add value, and are not intended for sale within the next 12 months. Examples include patents, copyrights, trademarks, and goodwill. Patents provide legal protection for inventors, preventing others from copying their inventions for about 20 years. Others must pay a fee to use, manufacture, or sell these inventions. Copyrights protect original artistic works, such as books, music, movies, and software. They ensure that creators can reproduce their work only with permission, typically lasting for the creator's lifetime plus 70 years. Trademarks protect distinctive signs that uniquely identify a brand, product, or business. They can be names, symbols, or images and have significant value, often being sold or licensed. Goodwill represents the value of a company's reputation, customer base, or business connections. It is often evaluated when a company is sold, reflecting the premium price paid due to the company's intangible qualities. Customer and contract-related intangible assets include contracts, customer lists, licensing agreements, and construction permits. These assets are crucial for maintaining business operations and relationships. In this section, we will delve into the final accounts, focusing on depreciation methods such as straight line and units of production. We will also evaluate the appropriateness of each method. While property tends to appreciate over time, most fixed assets depreciate. Depreciation spreads the purchase cost of an asset over its useful lifespan. Items depreciate due to wear and tear, like computers and shoes, and obsolescence, as newer and better products become available, making old items less valuable. We will learn about two main methods of depreciation: straight line and units of production. Depreciation is an expense included in the profit and loss statement and affects the balance sheet. Straight-line depreciation is the simplest and most common method. It requires three key variables: life expectancy of the asset, residual value, and purchase cost. For example, a security system bought for $25,000 with zero residual value and a 5-year lifespan would depreciate by $5,000 per year. If the security system has a residual value of $5,000 at the end of its 5-year lifespan, the annual depreciation would be $4,000. Straight-line depreciation is simple and easy to calculate but may not accurately reflect the actual decrease in asset value, which can be higher in the first year. The units of production method focuses on usage, where the asset's value diminishes with actual use. Depreciation expense is calculated based on the units produced during the asset's life. To calculate depreciation using the units of production method, divide the depreciable base by the total estimated units of production. Multiply the depreciation per unit by the number of units produced.